Hello and welcome to 5-Year Club video number 107. I'm going to talk about non-deductible IRA contributions and a tax form, Form 8606, that you need to be filling out and that I've messed up on and a lot of other people have messed up on. So I'm going to give you the rundown so that you don't make the same mistake. All right, so let's back up a second and just review IRAs. IRA stands for Individual Retirement Arrangement, and generally speaking, it is a tax-sheltered retirement account with a yearly contribution limit of $5,500 or $6,500 if you qualify if you're beyond a certain age. I think it's above 55. It's called a catch-up contribution. Anyway, and there are two flavors of the IRA. There is the Roth IRA, which is a post-tax flavor, meaning that you contribute post-tax money that you've already paid taxes on, and then that money will grow tax-free, and you can withdraw it tax-free when you finally retire after age 59 and a half. The other flavor is a traditional IRA, and the traditional IRA money is pre-tax, and when I say pre-tax, that means that some people can take a deduction on it on their taxes. So technically they did not pay tax on that money immediately. However, later, when you withdraw the money in retirement, you are going to be paying taxes on those withdrawals. So, if you were a high-income person in California, you wouldn't qualify for the Roth IRA because they have income limits. But the traditional IRA, you might want to contribute a bunch of money to that and then leave the state and then pay the taxes later in your life when you live in Texas where there's no state income tax. All right, now let's get into the nitty-gritty details of the traditional IRA. If you are not covered by an employer-sponsored retirement plan like a 403b or a 401k, so if you have no employer retirement plan, then you can deduct the traditional IRA from your taxes. And since I've worked at some startups that didn't have employer plans, then I was able to deduct that. However, in 2015, my employer got a plan, which was awesome, but it meant that I could no longer deduct my IRA because I was beyond the income limits for the deduction. And these are the income limits. If your income is below $62,000, you can take a full deduction on a traditional IRA, even if you have an employer-sponsored retirement plan. If your income is above $72,000 and you have an employer-sponsored retirement plan, then you cannot take a deduction on the traditional IRA contribution. And if your income is somewhere in between these two, and when I say income, I mean modified adjusted gross income, and you can go somewhere else for that definition because we're too busy here to talk about that now, you will get some kind of prorated deduction that's less than the full amount that you contributed, but greater than zero. So that's the deal that you get. Alrighty, if you are in the category of people whose modified adjusted gross income is above $72,000, then you need to file this Form 8606. And I pulled this from the IRS website about Form 8606, non-deductible IRAs. If you do not file Form 8606, then if you withdraw the money later in retirement, or you do a conversion, a Roth conversion on the traditional money, say you leave the state and you decide that you want to pay the taxes and convert that traditional IRA into a Roth IRA so that you don't have to pay taxes even later in life, then if you do not file Form 8606, you will pay taxes on your contributions that you could not deduct, which means that you are going to get double taxed on that money. So, for example, if you contribute $5,000 a year for 3 years in a row, okay, then if you do not file Form 8606, then someday that's $15,000 that the IRS is going to tax you on again. You've already paid taxes on this money because you were not able to deduct it on your taxes. So you need to file Form 8606 for every single year that you make a non-deductible IRA contribution. 8606 keeps track of what they call the basis, the non-deductible basis. What the basis is just you adding up all of these non-deductible contributions so somebody knows what the total amount is. And, in my case, my taxes are messed up right now because TurboTax did not file 8606 for 2015. Then it did file it for 2015. It did not file for 2015. It did file for 2016, but it said my basis was 0. And I'm pretty sure my basis was supposed to have been, $5,000 or $5,500 or whatever the max contribution was because I had maxed it out. And so now it has again filed my taxes for 2017 without filing Form 8606. And I think its excuse was that the IRS hadn't released the form yet, but it didn't stop me. It didn't tell me, and that's really crappy. And its accuracy guarantee does not cover the Form 8606 situation. It only covers situations where the IRS complains. And of course, the IRS is not going to complain about me not filing Form 8606 because they are happy to take my money again. And so this is just kind of a crappy fact of the system, is that now I have to babysit TurboTax every year to make sure that they file Form 8606 so that my basis on my IRA is correct, so that I am not overtaxed on the money inside my individual retirement arrangement. All right. And small fun fact, if you have not filed 8606s for past years and you need to file them, you can. There are rules online. You have to find the 8606 form for every year that you missed it and fill out that year's form. You need to put in a cover letter that explains your reason for not filing, and they want it to be a good reason. You can look up the reasons that they cite are okay reasons. If you do not match their okay reasons, they can charge you $50 per year to file these. But it is worth it because we're talking about taxes on $5,500 for every year. If your tax rate is even 20%, that's over $1,000. So you would be paying $50 to avoid a $1,000 or more tax. That's a good deal. Even if it's crappy that you would have to pay $50 to fix this, the taxes are going to be worse. Yeah. If you don't remember filing any 8606s and your income was over $72,000 a year and you made traditional IRA contributions, you need to review this on your taxes to make sure that someday when you are taxed on this money or when you decide to do a Roth conversion, you are not double paying the tax on thousands of dollars because, man, we are taxed so much already. We really do not need to pay these additional taxes. I'm going to put this IRS link in the description so that you can download Form 8606 for yourself, read the lovely IRS instructions for Form 8606. And I'd also suggest that you search Google about this issue because there's a lot of details beyond what I've talked about here. It was a form that I started to learn about in the last 2 years, and I wrote myself some blog entries about it, and now it has come back to kind of bite me in the ass, I think it is safe to say. Perhaps it's not that bad. Perhaps, my 2015 taxes were correct somehow. I don't know, but perhaps not, and I got to go fix it. It's a bummer. So I wanted to make this video to save anybody who is in the same situation as me, or might be in the same situation as me in the future. There is a weird, crappy form called 8606. TurboTax fucks it up. You need to manually review your returns to make sure that they are correct, so you are not going to pay double tax on this money. All right, that's it for 5-Year Club video number 107. Oh, the most exciting topic I've done this entire week. What a wild Friday night it's been. All right, guys, have a great evening.